Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen. That's ABRDN, wherever you get your podcasts.
You have to take a stock and you actually have to start reading the financials, actually start investing. And they don't do that. They do it is very surface level. Like they'll have you build out models. And models they're sort of useless. You can't really, you're never going to be able to project anything accurately.
Hi there and welcome back to Stocks for Beginners. I'm Phil Muscatello and I'd like to welcome my guest, Siddharth Singhai, co-founder and CIO of Ironhold Capital. Hi there, Siddharth. How's it going?
Hi there, Phil. I'm doing well and it's my pleasure to be on the show. It's a wonderful show and thank you for having me.
So you started in mechanical engineering, not in financial services. Tell us a bit about your background in your previous life.
Yep. So I'm a mechanical engineer. I did undergrad in engineering, and that was sort of a social proof based decision, and I did not really put a lot of thought into it. My father is an engineer. Mm-hmm. My mom is a PhD in psychology, and I was reasonably good at mathematics. So I thought it should work out well with engineering because it does require a little bit of math. Yep. It's a hard science, and I found myself more interested in economics and investing in general. After college, I decided I would change my field and get into finance. And I worked for about 1.5 to 2 years in finance. And then I came here to New York and I pursued master's in finance from Fordham University, Gabelli School of Business. And that's where I met Paul.
And so before we get on to Paul and Ironhold Capital, you had the good fortune of meeting a billionaire who helped change your life and move you into financial services. Tell us that story.
Yep. So the billionaire we're talking about is Mr. Ramadou Agarwal, and he is probably the top 5 value investors in India. I met him at an event, and I just had like 10 minutes of conversation with him. And so I was trying to figure out how I could become a better investor and how he did it himself. And very interestingly, he used to actually fly out to Omaha during the 90s when there was no internet, and to learn from Mr. Buffett himself. And he used to wake up at, I think, 5 a.m. and he would read financial reports of Berkshire Hathaway, the annual reports. Mm-hmm. And that's sort of what was his education. And the advice he gave me was, if you could just read those letters, you'd be good enough. And so I was introduced to Mr. Buffett. I knew who he was before that, in that he really directed me as to how I should go about learning investing.
He's quite an inspiration, isn't he? And his advice is incredibly useful to a lot of people. Can you just maybe tell us 1 or 2 points that really inspired you from Warren Buffett's thoughts and newsletters?
Yep. So he's an inspiration both on personal side of things, as far as what qualities you should have as a human being, and also technically as an investing. And on the personal side, integrity, he's very well known for that. And he hires people who have integrity, intelligence. So that sort of stuck with me, like especially in the field of finance, when people trust you with their money, the most important thing is to make sure that you do a good job for them. That was number one, integrity. As far as investing itself was concerned, buying high quality businesses and thinking of yourself as a part owner in a business instead of looking at them like these stickers that you see have a price that fluctuates every day. That sort of was transformative as well. So I think those would be 2 big things.
It's interesting, isn't it, that the way of thinking about that? It's really gone by the wayside, the idea that you're investing in a company. So many younger investors now are hitting their Robinhood apps and they're just looking at the numbers on the screen and it's almost like watching a horse race for some people. But it is a fundamental thing that's important to understand, that you want to be in a company and that you're a part owner of that company. Mm-hmm. It's like if you'd started your own company, how you would to look at it that way as well.
Yeah, absolutely. The trading mentality Robinhood is great in the sense that people can get started really quickly. It's very accessible. But with the ability to trade stocks and with the news and especially with social media and social proof, the long-term thinking has sort of gone out of fashion, at least a little bit. I mean, it was always a little bit fickle, but especially in this day and age, people jump in and out of stocks within a day, maybe multiple times a day. So that doesn't serve them in terms of creating their wealth over time. And what the sad thing about that is, if you get into the market and then you trade and then you don't make money, or you lose a significant amount because you made money and then now you got unlucky, you sort of give up on the stock market completely. Like, people think it's gambling, and so they sort of almost dismiss it, instead of, if they had the right approach, if they just had enough knowledge, like, you don't even have to do anything spectacular in the stock market. Just do a little bit of dollar cost averaging every month and an index fund, and that will do well over time. But it's a weird mentality because the information is out there, and it has been out there for ages now. I think it's sort of thrilling in a way, investing. So it sort of invites that sort of alpha type behavior in people.
It's interesting too when you think about Warren Buffett is running such a huge fund, but it's basically on a very small office, where there's a lot of mutual funds that are running far less amounts of money, and they've got dozens of people there trying to work it, whereas it really speaks to that idea that you have to have patience and let the garden grow.
That's actually it's really interesting to see how you can throw a lot of brain power, because all those mutual funds really hire really smart people. And the idea is that if you can hire enough smart people and then make them work on one specific problem, it should give you good results, but it doesn't. With a lot of mutual funds, the reputation of the manager is at risk. Anytime he does anything differently from the norm, it's sort of, his job is under threat. It's difficult for them to create alpha. When you have that sort of job pressure, you can't really do anything. You deviate from the norm and then you underperform when the market is up. If you do badly when the market is doing badly, it's susceptible to a lot of investors. But otherwise, it's just a problem. And that's why they sort of hug the index, and a lot of mutual funds sort of start mirroring each other. And so that also, when you add fees to that, it sort of gives the returns.
You use the term create alpha. What does create alpha mean?
So creating alpha would be having a performance superior to that of the market index. So a market index like an S&P 500 or Dow Jones. Over long periods of time, they'll give you a return of maybe 8 to 10% in that region. Creating alpha would be, you take a skillful manager and he does active picking of stocks or maybe other asset classes that allows him to get better than those 8 to 10% returns. The name for that is alpha. You generate alpha. So
alpha is just superior returns to what the general market delivers. Okay, let's get back to talking about Ironhold Capital and meeting your partner, Paul Gray. Tell us a little bit about that. That was at Fordham University, wasn't it?
Yep. So we were introduced to each other by a mutual friend, and we were competing in a consulting contest. I think it was ACG Cup. Unfortunately, we didn't end up participating because 2 of our members got ill, and so we had to drop out of the contest. But me and Paul hit it well together because he's also had read up on all those books, and he had that frame of mind of a long-term value-based investor. And he also wanted to, he is slightly older than me, and so he's a lot more experienced, and he wanted to do something on his own now. And the same was for me as well. I wanted to start my own hedge fund. The only reason I couldn't do it in India is because you actually need a degree qualified to do so. That was the original intention of me pursuing a master's. We got together, and this was about almost a year and a half ago, and then we started building out the strategy. What's our edge?
So Paul concentrates more on real estate, doesn't he? And you're looking at stock market returns. Is that the case?
Yep. He has experience in real estate, worked in a private equity firm and, an investment bank. He also has a few commercial properties that he has for himself privately. So we look at it together, typically. So it's not just him looking at real estate and me looking at the equities, but that's more of his game, and mine is more equities.
Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen. That's ABRDN, wherever you get your podcasts.
ShareSite is an online portfolio tracking tool that automatically records trades, dividends, ETF distributions, and gives you the reporting tools you need to help you manage your portfolio. ShareSite is pleased to extend a special offer to listeners of this podcast. 4 months free on an annual premium plan. Go to sharesite.com/stocks for beginners and sign up now for a free trial before taking advantage of 4 free months. It'll help you save money at tax time and improve your investing decisions. That's SIGHT.com/stocks for beginners. A young person getting into the financial services industry, what advice would you give them? Well, first of all, is it a good place to work?
So I think that would depend on the person himself. I mean, I was very passionate about it way before this was about 6 years ago when I started reading about finance. So it was through natural interest, and it's a really competitive field, especially in the US. I would not suggest anybody who's not really passionate about it to actually try and pursue investing. I mean, it's no different than if you become a doctor or engineer. I mean, if you think that there's a lot of money in finance, that's only if you are able to ascend to the highest leagues in finance. Mm-hmm. And so that would take a lot of effort and time. And so if you're not really passionate, I wouldn't say you should. But if you are, then, this is a wonderful place to be, especially in the US. And also in India as well. It's very rapidly growing industry, I would say, asset management in India. My advice would be the advice I got. You have to develop your craft for a number of years, and you have to learn from the best, stand on the shoulders of the giants. So if you can find mentors, in my life, I had Mr. Ramadeo Agarwal, Mr. Joel Greenblatt. You could possibly find a few, either through books or maybe, if possible, in person. That'd be great. Mm-hmm. That will cut down on the learning curve.
So tell us about the universe of stocks that you look at.
So I look at India and the US. We are not restricted by market cap or by any specific industry. So we have a screen that we've developed. It's called Global Deep Value. It's our proprietary valuation strategy that we apply as a filter of stocks. A filter that screens out a lot of stocks that are already high quality, employ a modest amount of leverage, and are cheap. So those are our sort of 3 tenets. And after that, I just do risk analysis, layers upon layers of risk analysis. So it's more active deselection rather than active picking, because the strategy already does the hard work for us. We just go through what's the quality management. Are they doing any sort of accounting manipulation? Is the balance sheet strong enough? Or was there some sort of a temporary upsurge within the industry which allowed the stock to clear the screen? So it's not actually cheap. It's a value trap. So we check for those. Yeah, so it's not really any specific industry but it is mostly stocks.
I like to talk about specific things where we talk about jargon and try and explain that jargon for people. People listening to this have got no idea about the stock market or valuing a company. But you mentioned a small amount of leverage. What does that mean?
Mm-hmm. So leverage is taking on debt to finance your operations. If, let's say, somebody has a bakery and he starts that bakery off with $1 million, out of which $700 is his own money, $300 he takes from the bank. Those $300,000, that's leverage. Leverage and debt are pretty much the same thing. It just, when the business is doing well, they call it leverage. So it's leveraging up the returns.
Yep.
When it's a burden, they call it debt.
And you mentioned the balance sheet. Debt or leverage shows up in the balance sheet. Is that the case?
Under the liabilities section, you would have long-term debt, current portion of long-term debt, short-term debt, and then you would have other liabilities, which would be accounts receivable. It shows up within the balance sheet, which sort of serves as It's like a snapshot of the business at any given point in time.
And this can all be found in an annual report.
Yes, annual or quarterly reports
Mm-hmm.
will have financials of the company for that given period.
Getting back to Warren Buffett, this is his favorite reading, isn't it? Reading company reports.
Yes, Mr. Buffett typically reads about 5 to 6 hours a day.
Mm-hmm.
It's a bunch of things. It's newspapers, it's annual reports, it's proxy statements. In his younger days, he used to read about actual investing.
Mm-hmm.
So economics and maybe investing books like Security Analysis is probably the most recommended book by him. His reading is sort of more diverse, but as he has matured, it's more about what's going on. I mean, specifically, he reads about what's going on in one particular industry, mostly microeconomics. He doesn't read other analyst reports or opinions. He's trying to gather as much data as he can and then make a decision based on that.
One of our other guests has mentioned the idea that one of the best ways to learn about investing is to take a small holding in a company, just something very small that you can afford, and then study everything you can about that particular business, and especially by reading all of the reports and everything that you can about that industry. Do you have any sort of advice like that for a new investor?
Yep, I think that advice is pretty much spot on, because we do have analysts, and these are really smart kids from top business schools, and they already have a background in finance and economics and maybe accounting. But when they're faced with an annual report, you sort of have to, investing is sort of like a combination, accounting, economics, and then psychology to an extent. They're not able to synthesize those things because it's not really taught in business schools, business valuation or how to read an annual report. What they end up doing is they start applying formulae and they start looking at just the ratios, which is inadequate amount of research. You have to be able to understand accounting so fluently that you can just glance at something, a financial statement, and then you can glean a story about the company from it. And I think that sort of takes a long time. So you really have to be very comfortable with accounting. It's accounting and also economics. And I think a lot of people in corporate finance don't know economics. And if you don't know both of them, like finance doesn't really teach you a lot about investing.
This is shocking news to me that people are coming out of these schools and they can't read a balance sheet and they don't know about economics.
That is actually surprising because it's not something that you can, even I was in business school not so long ago, and there was no class on business valuation anywhere, in any of the business schools. And that's you have to take a stock and you actually have to start reading the financials, actually start investing. And they don't do that. If they do it, it's very surface level. Like they'll have you build out models. Yeah. And models they're sort of useless. You can't really, you're never going to be able to project anything accurately, 100%. The CEO of that particular company won't be able to say, this is exactly how much money we will make in the next quarter. So that is a futile exercise, and they focus a lot on that. It's not like an exact science investing. So they approach it with the wrong mentality, I would say.
Off the top of your head, is there a particular stock that we can just focus on for a moment and talk about and how you value that particular stock?
So I think probably the best stock that I found overall is Lam Research Corporation.
And by the way, this is not any advice to buy this particular stock or anything. Yep. We're just using this by way of an example. Okay.
Yeah. So it's a semiconductor equipment supplier. So what they do is so semiconductor is basically a device that has a 0 and 1 circuitry. It allows you to transfer electrons from one place to the other. Basically, it's much like a calculator, like a microcalculator. And so anytime you're processing or calculating anything, velocity, graphics, or sound, you need processors. And those processors are based on semiconductors. And so that technology, that industry, if we start with how I go about it, look at first the demand, then the supply, or the competitors. Then I would look at what's the management look like. Then I would look at valuation. And then after I've done all that, I might get a range of intrinsic value for it. So in case of Lam, Semiconductor industry is growing at about 15 to 20% a year, which is quite handsome. Lam Research, within that whole industry, is positioned as an oligopoly. There's no direct competitor to Lam. There's maybe Applied Materials and Tokyo Electron, but they all have slightly different processes. The reason why they don't have any, like the moat or the competitive advantage that Lam has, is it's a really very sophisticated type of production. If I was Samsung and I wanted to make, let's say, memory chips or processors, I would have to build out a facility that cannot have any dust particles whatsoever. It has, like, you can't even breathe. So they have to put on the whole gas mask and like the oxygen cylinders, so they don't pollute the air because it interferes with the production process. So it's really hard to, first of all, they've been doing it for decades. And so it's hard for some newcomer to actually come in there and, try and replace them. And there's also this great economies of scale. I mean, the more business they do, the costs keep coming down. So for me, as an entrant, as a competitor, I can't do it cheaply than them, and I can't do it better than them. So it sort of is a natural oligopoly because of that. So that is a sustainable competitive advantage. The bigger they get, the stronger their competitive positioning gets because of that scale advantage. So that's the second part. Third is that the management is pretty smart. They buy back stock when it's undervalued. They employ almost no leverage. And the business is a high quality business. Return on invested capital on an incremental basis is in excess of 50%. So it's a really high quality business. I think they have to invest like 300 million and they get 800 million out.
So that's the measure of the return on invested capital. Is that correct?
Yep.
That's the metric.
Yeah, that's the metric. Mm-hmm. If you were to measure quality of any business, you have to look at what's the return on invested capital and can they maintain it? So yes, we're talking about management. They really are diligent. They take care of their shareholders. They're not diluting equity. They're not doing value destructive M&A. They're not doing any of those things. When we look at the valuation, it's trading at, I think, a PE of less than 25. Mm-hmm. And actually, it's a lot lower now, I guess. For a company of that quality that is also growing at 15-20%, that's a really cheap valuation.
Mm-hmm. This is one of the basic valuations, isn't it, PE? Tell us a little bit about that in this case.
So if I have a farm that's producing $1 million worth of income for me every year, if somebody else comes to me and offers to buy that farm for $10 million, that's a PE of 10. If he offers to pay me $20 million, it's a PE of 20.
And it's price-earnings ratio, isn't it?
Yep. It's price-to-earnings ratio. Mm-hmm. Its significance is that it shows you how expensive or cheap something is. Mm-hmm. In this case, a stock. So for Amazon, it's like 100.
That's very expensive.
That's the tricky part. Because
that's right, yeah.
It is growing really rapidly. So it's not just, you're not paying for the million that it's producing right now. You think he'll be able to take that million and buy another farm and then another farm. So we'll have like 5 farms that will each produce $1 million, maybe 5 to 6, 7 years from now. Mm-hmm. And so you can pay up in that case, but there is a limit. And that's where it gets really complicated. Should you pay up for growth? And if it doesn't happen, like with Apple were growing rapidly. Mm-hmm. But in the last 5 years, they just petered out. So if you were betting on Apple continuing their growth story indefinitely into the future, or even 5 to 10 years down the line, you would have overpaid for Apple. Mm-hmm. The best example of an overvalued stock is Microsoft. Or it used to be. So in 2000, Microsoft was trading at about $60 at the peak of the dot-com bubble. And in 2014, I think 14 or 16, it was still trading at 60. So basically, Microsoft did really well and they grew a lot, but not enough to fit into that valuation. So that is the other place where people make a mistake. Just because something is going to do well in the market as a business, we all know that Amazon is going to do well. It's almost certain. Doesn't mean that the investors are going to do well with Amazon. You have to sort of come in at a price that's a fair price.
And that's part of the art of what you're trying to do, is not only to find the good business, but to get into it at the price that makes it worthwhile for you.
Exactly. Some businesses are like that farm that grows. They can take $1 million and they can open another farm and another farm. Those are wonderful businesses to hold on to because the value is going up year after year. Other businesses are like you have one farm and there's no need for another farm. There's no demand for it. But you can buy it for like 500,000 instead of $5 or $6 million instead of the $10 million. It's just that cheap. We ideally want something that can do both, that we can buy for cheap and is also going to grow. And that's why Lam Research is that unique stock. It's also cheap, about 20-30% undervalued, and it's also growing 15-20% a year.
You mentioned one of the qualities of Lam is that they do buybacks. Tell us about that. Why is that an indication of a good business, and what is a buyback?
So buying back would be if I'm Google, let's say, and I have $100 billion in cash that I cannot invest back into my business. I can't open up maybe more servers that will hold on to connections. What would I do with that cash? I can either return it to the shareholders by paying a dividend, or I can, if my stock is cheap, I can buy back my stock. If I give it back to the shareholders, it's up to them what they do with it. But if I know that my stock is 30% undervalued, I'm giving them a 30% return by buying it back. Google will buy its own stock.
And that's good. That's good for investors.
It depends on the company. So if that's actually the sign of quality management. If you think it's undervalued and they're buying it back, then it's a great thing. However, it's a bad thing if they're doing it because everybody else is doing it. And that we see that happen a lot as well. CEOs will just buy back stock because other CEOs are doing that. And it's actually detrimental to do that because a lot of people were actually complaining about it, that companies are taking a stimulus package and they're buying back stock instead of paying their employees and keeping the business intact.
Yep. So this is where there's so much art in this, in valuing companies, isn't it?
Yeah, I mean, that's why it's interesting. It's not, there's a human element to it that makes it really interesting.
Yeah, I can hear this when we're talking about this, that you'll give one example of something like that buybacks are good, but then on the other hand, they sometimes in some cases are not so good.
Well, actually, it's often not that good. But most managements, I would say, they're not incentivized to do well for the shareholders. They get compensated typically based on what the compensation committee of that particular company might decide. But it's typically the earnings growth or revenue growth. Well, that is not the metric, because I can sell a $100 bill for 90, and I can sell a lot of them, and it will show up as growth. But even the bottom line might grow, but you are essentially, it would be like if I took $11 million from the bank, I invested in my farm, and I only produce $5 million from it. So you are destroying capital, and a lot of them do that.
Okay, well, let's talk about Ironhold Capital, and if people want to get in touch with you.
So Ironhold Capital is a value-based hedge fund. We are based here in New York, Manhattan. We invest for the long run. We invest mainly in equities. We might do a little bit of credit default swaps and other sorts of. We might exploit those hedging instruments as well from time to time. But mainly we invest in India, in the US, and I think that's where the edge is. So if I were to describe our investment strategy, we invest typically, we have a 60-40 split of India and US, and sometimes it reverses depending on the market. And we are sort of the few hedge funds that invest. It's not truly globally, but it is still binational. And people don't really understand India, and they don't understand the prospects, the wonderful prospects it actually has. And so they sort of are ignoring it. And so the Indian markets right now are sort of like US markets of the 50s, where you can find a $100 bill for $70 or even less than that. And so people are sort of missing out on it. There are only about less than 500 mutual funds and hedge funds combined in India, compared to about 10,000 in the US. There are about 5,000 listed stocks in India and about 3,700 in the US. So you have a situation here where you have a lot of eyes on those few stocks, and it's really hard to find bargains. I mean, you do obviously find them from time to time, but in India, it's like a everyday thing. There's almost something tantalizing that has like extraordinary upside thrown at you every day. And
it's interesting with India as well. A lot of people don't realise how young the population of India is dynamic and well educated, which is surely a tailwind.
Yep. So that's actually the most interesting part about India, that the middle class is expanding rapidly. So the disposable incomes that Indians have will grow 10 times in the next 5 years or so. So that income would be spent on entertainment, on some reasonable luxuries, maybe some high-end luxuries. And at least for the middle class, they might, instead of having a car, they might have a car and a bike or 2 cars. And I see this with my friends. I mean, it's becoming wealthier. I mean, all nations are, to an extent, becoming wealthier, but it's growing rapidly. So compared to just a decade ago, people are in general a lot more well off than they were a decade ago. And that will continue to happen in the next few decades as well. Like asset management is probably the most attractive industry in India. Only about 6% of the entire population actually invests in the market, compared to about 50% in the US. And the population is also growing. So when we take those two things, combine them, it's you can expect it to grow at 15-20% for a very long period of time. And similar to that, there are other sectors in India that, like manufacturing, is really underutilized. It's really inefficient. The technology isn't there yet. Unlike, let's say, China, they really have state-of-the-art technology and so on and so forth. So India will get there, and that will create opportunities for investors.
Yep. Siddharth, thank you very much for joining us today on Stocks for Beginners.
Well, it's my pleasure to be here, and thank you for having me.
Stocks for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Stocks for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. And thanks to Christopher Soulos for music production out of Garlic Breath Studio. Music flows when the money don't.
Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen, that's ABRDN, wherever you get your podcasts.